Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into today's episode of the Money Insights Podcast. My name's Christian Allen, and I'm here with two guest hosts for the day. People you know well. First, we've got Blake Never Takes a Break. Brogan. Blake, what's up, man?
It's always good to see you, and I'm always working.
Thanks for filling in for Rod the Pod today. He's out doing some family things. And second, we have Brenyn, Babyface, McConnell. Brenyn, what's up, my man?
Just glad to be here. Oh, always getting younger.
Always getting younger. You got to just lean into that, man. Yeah. Can I just tell you, that was, I'm trying to think of who was it that gave us that idea? Do you remember?
Yeah, Josh.
Okay, that's right. Josh. Huge shout out to Josh for giving. He even gave me one. He called me Christian the Answer Allen. Is that right?
Yeah,
something like right. That. So yeah. I was like, man, I'm liking this. Anyway, excited to have you guys here. Like I said, Rod's out, but I appreciate you guys filling in. Today, our topic is why the safest investments are often the most dangerous. And there's going to be a correlating LinkedIn newsletter to the podcast. So work off of each other. It'll be out by the time you guys hear this. Okay, so why am I talking about this? Let me kind of set the stage a little bit, because I think this is a huge problem. Now, when I think about the safest and like these safe investments or safe strategies, philosophies, it's, you know, the traditional stuff that we talk about, not just like stocks, bonds, and mutual funds, but it goes to like CDs and money markets and a lot of these things that fixed annuities, like things that people are using because they feel like it's safe, it's secure, they know it's going to be there. But the problem is they're often creating for themselves a much bigger problem, right? And they're guaranteeing in many situations that they can't or won't get where they want to go. And so from my perspective, this is like a huge problem, and it takes a serious shift in mentality. I know it did for me, right? I grew up in Salt Lake City, Utah, hyper conservative, like the whole mojo around my world and around money was do the things that are safe, secure, you know that they're going to get you there. And it was only as I got older that I started to realize, as I was meeting with clients, meeting with people just regularly who were doing all the right things, right? They're saving the 401ks. They're putting money in 529 plans. Like they're checking off the boxes, but they're still like, I can't get there. And part of the reason I think is just because, expenses, or I shouldn't say cost of living, has far outpaced like the increase in wages. So there's a lot of challenges that exist. But from my perspective, the thing that has to change is the mindset has to shift into a way where we stop thinking about the accumulation model where we try to save up a bucket of money that we go out and invest to try to create a retirement income. And we have to start thinking about a more effective model. And our philosophy is really to take the best of both worlds, right? So we're going to talk about how that kind of applies to specific investments. Okay, so what are Brenyn and Blake going to do for us today? They have not seen the outline. They're just going to give us their raw takes on some safe investments, quote unquote, safe investments that we typically think of as, just super reliable. We get what we want to get. But that I would argue have some real dangers surrounding them. Okay, so do you guys have questions before we get into the meat of it?
No, I'm excited. I think this is going to be a great episode.
Okay, we're going to jump right into it. And I have like 7 or 8 of these, and we'll see how many it makes sense to. I want it to just be conversational. I want your guys' raw takes and thoughts on the good and the bad, right? So the other thing that I really want to do is make sure that we're presenting to the audience a kind of fair and balanced opinion on that. And we're really trying to make sure that we're hitting both sides of the equation. So we don't have to be in a rush. We're just going to roll through things. And when I say safe investments, some of these are actually investments. Some of them are more like philosophies, strategies, that kind of thing. But we're going to jump right into it. So I want to start with an easy one. Let's talk about cash and bonds. So Blake, if I told you, hey, I'm going to be super safe. I want to make sure that my retirement is secure. I'm primarily going to be investing in cash and bond funds or bonds. What would you tell me? Like, what would be the pros for that, and what would be the things that I have to take a step back and wonder, am I really making a good move? And now let me be clear. Sorry, hold on. Before you start, I have to just say this. Obviously, nobody is going all cash and bonds. So we'll kind of bring this together into like a more formulaic outline. But I think the key here is I just want to make sure that we're understanding what are the differences, or what are the pros and cons of these different philosophies, strategies, and investments. So that said, Blake, what's your take on something simple like cash and bonds?
So you've written a lot and produced a lot on the importance of having liquidity, right? And liquidity just solidifies your financial base, right? If things go wrong, and things are always going to go wrong financially in certain areas over the course of your life, having a lot of cash and having liquidity that you can access can kind of, smooth a lot of things over and allow you just to keep progressing. One of the dangers is obviously this concept of opportunity cost. So if you're primarily in cash or low risk investments that aren't yielding much, yes, you have some security there, but you're also missing out on other opportunities. So where I see this playing out with the people that we talk to, I'll just give a generic example. Let's just say you've got $1 million of liquidity, okay, or of investable capital. And someone might have 80% of that in their investments, chasing a rate of return, and 20% in cash or bonds or, treasuries that aren't doing a whole lot for them. Well, let's say you're chasing a 10% rate of return, right, on your 80%. Well, if you get that, that's a, growth of, 8%, or excuse me, 10% on the 800. So it's really on your total wealth. It's only a return of 8%. So a lot of times what we're talking to people and trying to help them with the situation is optimizing. Yes, we want to have liquidity, but having your liquidity in a place that's going to be more productive, in a place like the investment optimizer, where you're going to get tax advantages, you're going to get higher growth, and all the other benefits we get in these high cash value life insurance strategies. So I think it's having a balance of, yes, we want to have some investable assets, we want to have some cash, but only having cash and bonds, right? It's just not going to be doing a whole lot for you, even if, you have some other money earning elsewhere.
Yeah, you bring up a good one. And I have a couple of additional thoughts to that. So maybe the biggest risk is the opportunity cost, right? The opportunity to invest in places that would have created a far better return, far more income than what I'm getting there. But there's also like some really simple, basic risks that we have to think about. Things like inflation risk, right? Especially if I'm in cash. Well, we know inflation is typically, depending on the metric we're using, but let's say we're using like the CPI, we're probably still at 3.5% to 4% on average, right? So all of a sudden, if our money's in cash and it feels good, like I get this, it feels good to have a bunch of money in cash. Like it kind of feels nice. You open your bank account up and you're like, okay, like it's looking pretty hefty. I feel like I'm in a strong place. The reality is instead of that money doing what you want it to do, it's actually doing the opposite. It's literally losing purchasing power due to inflation risk, as an example. And so like, those are the types of things we have to be. Liquidity risk is another one. You brought up the critical importance of liquidity. Oh, I said that liquidity risk is not one you're dealing with. You're in cash. I was thinking of bonds specifically, right? So like in the cash side, you're obviously dealing with opportunity cost and inflation risk. On the bond side, you might be dealing with something more like liquidity risk. Like, okay, if interest rates are moving, my money's stuck in a bond for a specified period of time. Like, those things can be really difficult. But at the end of the day, bonds do provide some strong guarantees that a lot of other investments don't. So I want to make sure that while we hit on the challenge that exists, the real, like, I want to make sure that we properly value what it is to have safe things that we know we can count on. Okay, so The problem, though, as I jump back to the problem, is that bonds, especially right now, are at terrible interest rates. So like the combination of locking our money up, creating a liquidity risk situation, an opportunity cost risk situation, it's probably not worth it. So the only place, and this is kind of my final thoughts on bonds and cash, is they have a place in a very small portion of our portfolio today, right? And what I would probably do, to Blake's point, is I would look for cash equivalents that are actually producing more for me, because like I'm getting the same value, I'm getting the same liquidity, I'm just getting also simultaneously a better return, tax benefits, like you said, if we're using something like high cash value life insurance. Okay, so that was my softball one. Next, we're gonna jump to 401ks, Brennan. 401ks obviously are like, typically they're market based. And so that's an element of it. But I want to talk about kind of the overall pros and cons of 401ks. And again, with the context of, well, why in the world would these guys be saying that something as safe and simple as a 401k can actually be really dangerous for me?
Yeah, that's a great question. So, I mean, there's a few things that come to mind. One of them is you can't access your 401k until a certain age, right, without incurring a penalty. And a lot of people that we work with, they want access to their capital well before, they're 60 years old. And so that's one clear danger, is that when you put your money into a 401k, there are different ways to access it. You can loan against a 401k and things like that. But at the end of the day, you can't start drawing income from it until you're 60 years old without incurring a penalty. So that's one thing that comes to mind. The other one that comes to mind that I think is a big one is you have to weigh the taxes, both right now and what you think they will be in 20, 30, 40 years, whenever you're going to start drawing from that. Are they higher now when you're pulling the income or taking the income and putting it into the 401k, or are they going to be higher when you're pulling income in retirement? And a lot of people, what's funny is, and I would say this isn't typical of our clients, but it's typical of, I would say, the average Joe. When you ask them about retirement and say, do you think, if you're making $200,000 a year, how much do you want to take in retirement? Often, they'll say, well, I think 100,000 would be enough. And I'm like, wait a minute. So you're going to go from, let's say you're 63 years old, and you're going to go from a $200,000 a year income and lifestyle, and then you're just going to cut it in half to $100,000 a year, and you're going to be okay with that, right? And it's crazy. And I think most people just have never connected those dots. They just don't think about their retirement enough and what that looks like, pulling cash from retirement accounts to really, they just have never connected those dots. And so if you are pulling income from your 401k, and if it's a significant amount, so let me be clear. If the 401k is the only thing you have in your portfolio, or it's that and other, taxable accounts, you're going to be paying a lot of taxes in retirement. And if you're pulling $400,000 a year, if that's what you're expecting, roughly 40% of that is going to get taken away from just paying ordinary income taxes on your 401k. And so the danger is, if you're 80%, 90% invested in your 401k, and the other 10 to 20% is something else, that's the primary source of your income in retirement. And so you're going to get hit with a huge tax bill every single year in retirement. And so I think that's one of it's a major danger of a 401k.
Yeah, I totally agree. So you hit on some like really important, rock solid points that everybody has to be thinking about. And like you said, typically we don't, right? We don't think enough about the tax implications. Like, if we're going down that traditional road, we've probably paid off houses. We probably don't have kids as dependents. Like, our tax benefits actually go down over time, unless I get on the alternative side and I'm building up like a real estate portfolio, right? So the biggest danger that I believe exists from 401k is the mentality that slow and steady wins the race. Well, here's the deal. Slow and steady wins the race is a great mantra if it actually wins the race. The problem is that for most people, slow and steady guarantees that they don't win the race, right? And so this mentality is like, okay, the retirement date is 65 years old. I got to contribute to this thing as much as I can. And again, most of the time, the focus is on getting money into the account. And it's kind of like the plan is hope, right? And so what we're telling people is move away from the accumulation model, go to a cash flow model where all along the way I'm building up cash flow that's either happening now or I can turn on easily at the point in time when I want to walk away from like my job, my working situation. So in my mind, I just think about it's like one of the biggest lies that we're told as people that 401ks are the way to get there. In reality, they were the government's way of getting away from having to pay out pensions. Like that's the reality. Pensions existed. That was how people did it. Back then, slow and steady actually did win the race, right? You could work for 30 years and get a pension for 30 or 40 years. And like you lived like a comfortable, good life. But what happened? Well, companies realized, the government realized that model was bankrupting them, right? And so it was like, how do we come up with another model? That's when the 401k gets put into place, so that now that risk is shifted away from the government, from the companies, and now shifting toward the individual. Well, unfortunately, the individual is using the very same tactics that those very companies decided were not going to work for them.
Yeah.
Ooh, that was kind of a tangent.
I'll throw in one more thing too with that, because I don't think anybody should count on Social Security as a retirement source. If it's there for you, great. I just think there's a lot of pressure on Social Security, and I don't know what that looks like over the next 10, 20, 30 years. And so in my opinion, nobody should be counting on that as predictable income in their retirement. But if it's there, great. My point is, a lot of people will max out their 401k, and then they also have this Social Security benefit that they're like, oh yeah, I'll have $70,000, $80,000 a year for my Social Security as well. So if I can pull, 120 for my 401k, 80 for my Social Security, I'm hitting my $200,000 a year income mark, right? If that's what their goal was. Well, what they don't realize is the more money that you have as ordinary income, which is your 401k, the more money you pull from that, the more your Social Security benefits get taxed. And so it's just this vicious cycle of paying exorbitant taxes on your retirement accounts. And I think 8 out of 10 people that I talk to about Social Security, 401k, anything like that, they don't realize how much their Social Security can get hammered by taxes when they're pulling from accounts like their 401k.
For most of our clients, all of our clients, 100% of their Social Security benefit is going to be taxed at their taxable rate. Yeah. Just because that's where it's at. Like, it's surprising, I think, to people when they realize the income limit to like becoming fully taxable isn't very high. So if you're bringing in a 6-figure income in retirement, then unless that's coming from tax-free sources that are off the radar, like that's 100% going to change the percentage of your Social Security that's taxed. And Ronald Reagan once said Social Security would never be taxed. Well, he was wrong. And I was wrong. I said 100%. I actually think that the right number is 85, up to 85% of your Social Security can be taxed at your ordinary income rate. Don't quote me as definitive on that, because I haven't played as much in that retirement income space, and it's been almost a decade, but probably more than a decade actually. Okay, so we've talked about 401ks, we talked about cash and bonds. Let's talk about the safe withdrawal myth, the retirement safe withdrawal myth. We talk about the 4% rule all the time. Like, I know we don't need to get into a ton of detail on that, but regardless of it, the reason we talk about the 4% rule is because it's actually being used. Like, in my mind, it is.
You're telling me that 10% isn't a safe withdrawal rate? Because I hear some really prominent voices telling me 10% is a safe withdrawal rate.
What kind of voices are those, Brennan?
Well, if the market goes up 12% every year, compounded with no volatility, 10% should be just fine.
Yeah, why? It's crazy that we're not taking out 10 or 12% from our portfolios every year. It's nuts. Just ask Dave. I think it's absolutely crazy that people. Now, the interesting thing about this is that we actually like agree and disagree simultaneously, right? Because on one side, we agree wholeheartedly that this accumulation method of having just a boatload of cash that we're trying to create an income stream off of using almost exclusively the market is not necessarily a recipe for success. It could be, like it could be, but it also has a high possibility of failure. On the other hand, we also think a 4% withdrawal rate is absurd, right? Think about how ridiculous it is to get an income. Like we meet with people every day that are making $500,000, $1 million in income. Well, if I'm making $500,000 of income and I've got on a 4% withdrawal rate, I got to have $20 million in cash, right? I think I'm right on that. Something like that. But here's the thing. These people make a ton of money, but very few have 20 million bucks sitting in cash that they can take that 4% withdrawal off, right? Good news is there's a better way to do it. We're not going to get into that part of it yet, but I just want to give you a second, Blake, a minute to talk about why this concept of the safe withdrawal myth is actually very dangerous.
Well, first off, I'm impressed that you could do 500,000 times 0.04 live.
I don't know if I got it right still.
No, I think you did. I double checked. No, you did get it right. That was very impressive to me.
Thanks.
I think one of the dangers that you run in when you're using the safe withdrawal is one of the big reasons that the safe withdrawal rate exists, I should say, is that the early years of your retirement make all the difference. So if you get to retirement age and the market goes up for the next 10 years and you're taking a big withdrawal rate, you're probably going to be fine. Where the issues come in is the people who retired in 2006, 7, they've got this bucket of money. The market goes down. They're also consuming that. It's a double whammy where the market's going down. You're also taking withdrawals. And very quickly, your portfolio could be decimated. And you're just not going to have the income because 3 years into your retirement, you've got half the money in there that we're expecting to live off of. So it's really the sequence of returns that makes all the difference when you look at, taking money from a market-based asset. So I think this kind of goes to our cash flow model, which is to say, yes, some market money can be great. I mean, I think most of us, maybe all three of us, have money in the market. I'm not opposed to that at all. You just need to have other income streams that can weather those storms, right? So things that aren't necessarily tied to the market. So whether that's, again, a capital avalanche where you can take out money income tax free, or you have real estate streams, or you have, the sale of a business that's going to pay out over 10 years, or you got to find other income streams that you're not fully dependent upon that. Because I think just the biggest risk is we can't time the market. You don't know if you're going to retire in 2006 or if you're going to retire in 2010 and get a bull run for quite a while.
I totally agree with you, Blake. Sequence of returns risk is absolutely the biggest risk that we face when we're trying to use this kind of safe withdrawal concept. The other risk that comes to my mind, and I'm kind of restating this, but it's still a really crappy withdrawal rate. Like, so we're still using 4%. Like, it's not just that we're like, hey, this is risky. You've got a, 75% chance that it works out, and you've got a 25% chance that you run out of money and are desolate. Like, okay, that's not great. But even if it goes right, I'm still only pulling off 4%. So I'm almost guaranteeing myself that I should say this. I'm guaranteeing that I'm not getting the very best result. So here's the way that I view a market-based account. I view it as an accumulation tool. I do not view it as an income tool, at least if I'm using primarily equities. If I'm using an equity portfolio, like, it's hard to create consistent expected cash flow. I realize that, places like I go to Pepsi, like that's a good asset that's been doing it for a long time, but it's just not as efficient, not as effective as using some of the other cash flow models that we oftentimes talk about, where I can easily, I shouldn't say easily, but it can pretty reasonably get a double-digit return, a double-digit cash flow, and create an appreciation to go along with it. Like there's just like so much while, by the way, creating tax benefits all at the same time. It's just one of these mentality shifts that people have to get in. They have to take the good stuff that exists inside the market, and just bring in the alternative. It will just make such a big difference. Okay. So we've talked about 401ks. We talked about safe withdrawals. We talked about cash and bonds. I want to talk for a second about fixed annuities. Okay. So before I turn this over to you, Brennan, to talk about fixed annuities, just kind of, I'll give a quick synopsis, right? Annuities basically come in three forms. We've got variable, indexed, and fixed. I actually don't like variable annuities because it's usually wrapped in higher fees. So I'm not a huge fan of that. It's like the market wrapped in heavy fees typically, although there are some exceptions. It's not all bad. There's like situations where I could find like an income rider that's valuable, that kind of thing. But my mentality on annuities has shifted dramatically as I've met with people who are successful, wealthy, and like what I would call like a wealth builder. And the biggest reason, the biggest thing that I noticed really quickly is that typically those types of people aren't using fixed annuities, right? And again, fixed annuity just gives a specific interest rate for a specific period of time. So it might be a 7-year guaranteed annuity at 4.2%. Okay, Brennan, talk about why fixed annuities specifically could actually be dangerous.
Yeah, I mean, there's usually liquidity risk with a fixed annuity, right? They have what do they usually allow you to get 5 or 10% or something one time?
Yep. Usually you've got a 10% withdrawal opportunity that's like, oh, it's usually 10% per year. So like they do build in some element of that, but it's still not a lot.
Yeah. So there's still some liquidity risk there, or liquidity danger. On top of that, the returns are usually just really low. And so there's so many different options for you to put capital in a place that's safe, predictable, that can just earn you more than what a fixed annuity can. And it gives you 90 to 100% liquidity, right? And so I just think the returns on a fixed annuity are just not great.
It's not worth the like the payoff or the trade-off isn't worth it. So this is crazy to think about. We can build a high cash value life insurance policy that produces a higher return than probably 97% of all fixed annuities out there today. And like, to your point, it's completely liquid, right?
Yes.
And so that's a huge difference. And not only that, but I'm getting the better tax benefits. I'm getting a death benefit. So like, there's not a really good reason for people today, in my mind, to use fixed annuities. So I wanted to make sure, basically it goes back to the same thing. You're guaranteeing that you're going to get a crappy return with not very many tax benefits. I'm going to lock up my money. And so again, in my mind, maybe this was just a layup easy one, but I wanted people to be thinking about, again, safe places that may actually be doing the opposite of what I think they're doing.
Yes. Yeah. And I think that's it. I just think it as simple as it is, very low liquidity in a fixed annuity, very low return for what you're getting. And there's, a handful of different options that are far better in terms of producing the liquidity and a better return long-term.
Okay. I like it. I have a couple more that I want to hit on, guys. So the next one I want to hit on is more of a philosophy. You're getting some of the philosophy. Actually, Brendan, I'm going to leave this one with you, and then we'll go back to Blake in a minute. Great. So the philosophy of paying off your mortgage early. Why is that something that could actually be more dangerous?
Again, liquidity is a huge issue with paying off your mortgage.
This feels like a trend, this whole like liquidity, low return thing. Weird.
You're just dumping it into your mortgage to let it sit in the equity of your home, right? Like but not only that, right? So let's go beyond the liquidity issue with it. You're not getting any tax benefits anymore, right? Because with a mortgage, you can use the interest right off on your taxable income. And so there's no tax benefits when you don't have a mortgage. In addition to that, I think the biggest argument when I talk to people that are like, because there's actually a lot of people here where I live in Utah that love paying off their mortgage. That's just kind of the culture. That's what they're taught. Pay the mortgage off, get out of debt. And I'm okay, if it's a peace of mind thing, right? If you're just like, I can't handle, I'm so anxious having this mortgage out there, this piece of debt, then you can't argue that, right? Then, talking about math and money doesn't really make sense. It's a different conversation. So if that's how it is, you're just going to do it. From a financial standpoint, it just doesn't make sense. And what I'll typically tell people here in Utah when they're wanting to pay off their mortgage, right? Let's say they have $300,000 that they've been saving up, ready to pay off their mortgage. I typically just say, look, let's set that into a place like, if a high yield savings doing, 4 or 5%, great. But even better scenario is let's set up an investment optimizer policy that you can stash all that cash in. It's liquid. It's available. So if you ever want to dump $300K into your mortgage for any reason, it's ready to go, right? But the appreciation on your mortgage is going to happen regardless of if you have that $300K liquid sitting in there or not. Right? You're going to earn the 5 to 6% appreciation on your mortgage, whether you have that 300 grand in there or not. So let's get that 5 to 6% appreciation in the mortgage, but let's also get 5 to 6% appreciation in an investment optimizer policy and get the death benefit and get the long-term care benefits, and it's growing tax-free, right? So that's really it. The liquidity is terrible in a mortgage. You never know what the HELOC rates are going to be, or if you can get a HELOC, right? That's always a question. And then there's just way better places to store capital where if you really want it available at any moment's time, you can still have it liquid and available. You're just going to be earning an additional 5 to 6% in an account, and you get the equity in the mortgage as well.
Yeah, I love that philosophy. If you're someone who needs like that kind of connection between money and a mortgage being paid off or debt being paid off, having kind of that side account that you just look at on your balance sheet right next to your mortgage, that thing's growing. Well, especially if you're paying 3 or 4%, like I can't tell people enough how much more effective they can use their money by not paying off a mortgage early. Let's play this liquidity risk thing out for just a second, because I think this is an important one. Especially if I'm paying off my mortgage early instead of investing and saving my money elsewhere, right? So here's one of the things that a lot of people, and you hit on this. What if I can't get what if I don't have access to my money? So now let's say that I've been really, really diligent at making sure that I'm paying down my mortgage. I'm doing that instead of investing. I'm doing that instead of, just putting it in the bank. And the reason I am is because I don't want that debt on me. But let's just say I've paid down 80% of my mortgage and suddenly I become disabled, I lose my job, or some other financial catastrophe comes into play. And suddenly what people don't realize is it's actually way more dangerous to be in that situation. Think about just, again, if I'm in that dangerous situation, something happens and I've got a liquid pot of money versus I've got that money stashed into my mortgage. Well, I can't go to someone and say, I can't go to a bank and say, hey, I just lost my job. Now I need to get access to that money. They're going to be like, well, how do I know you're going to be able to pay it back? Right? Suddenly the risk is like it's not making sense to them. And now you're in a position where you're actually, again, in a far more dangerous position than you would have been had you just had that extra capital. And again, that has nothing to do with the mathematics behind it. The math just says, hey, if I can even generate a little bit better, like, again, I don't hate to keep touting the same things, but like high cash value life insurance at 5.5%, let's say that the average return is somewhere between 5 and 6% over the next 20 years. And I've got a mortgage sitting at 3 or 4%. Well, I'm literally creating a positive arbitrage every second that I don't pay down my mortgage. So
yes.
Anyway, it's a mentality thing, but I get it. We have to kind of change that mentality.
And I will say just a 60-second thing here too, because that's at a high level is kind of how I view paying off the mortgage early. I will say there are some really great strategies with some of our community partners, like the shred method, where if you're looking to decrease your mortgage payment, so maybe you have a 7.5% rate, you've got a really high mortgage, and you want to dive into that principal and then recast the mortgage to drop the mortgage lower. Maybe it's for peace of mind. Maybe it's because you're trying to turn the property into a cash flowing asset for you, right? There are some things and some strategies that make a ton of sense if you're paying down the principal on the mortgage. Now, a lot of times with the shred method, we're not paying down 100% of that mortgage. A lot of times we're paying down a big portion of that mortgage to create that cash flowing opportunity. And sometimes, again, people sometimes like having no debt there with the shred method. And so they will use, the shred method to pay down all of that debt. But the idea behind the shred method is not to pay it down and leave it there. The idea is to pay it down, access it with a HELOC, and utilize the investment optimizer strategy to go out and create wealth in other places, such as real estate syndication, self-storage, any cash flowing asset that you can think of. So there are situations where I do think it makes sense to pay down the mortgage, but you really want to have a clear-cut strategy behind it. It's not just paying down the mortgage because you think it makes financial sense.
Love it. Well said. Well said. Okay. I'm going to do one more, just because I don't want to go too long, but Blake, I'm going to tee this one up for you. I think this one's important and you might be surprised. Tell me why whole life insurance might be a dangerous investment.
Okay. Well, sometimes I think about this and it's like, with the strategies that we use, we're big proponents of specifically designed life insurance policies as a way to, to get a specific outcome, whether that's higher rates of return in our investments or to be used in conjunction with a strategy. So while I'm a huge proponent of that and have been doing that really my whole financial life, the risk is that we just throw this term whole life insurance out there and act like they're all policies and all designs and all companies and all strategies to use with it are equal. So that's where when you hear the idea of like, don't put your money in whole life insurance ever and use it to build wealth in build wealth in retirement accounts or whatever else you're doing in the accumulation model. I can see where they're coming from in that if you're buying improperly designed life insurance policies. And what we mean by that is where the focus is mostly for death benefit, right? So if you're saying, hey, I just want this permanent insurance, what's the minimum I can pay for that? Your cash value, we're talking about growing at a 5+% tax-free return. That's going to drop to, I'm guessing 2 to 3% over the long term. And you're not building up much liquidity for a really long time. You might not be break even in that policy with the cash value for 12, 15 years type of thing, as opposed to, 4 to 6 years in other designs. So just storing your money there with the idea that, hey, I'm going to get, my family's well protected, but it's 50 years down the road. There can be some incredible opportunity costs by having your money grow at a rate way less than inflation over the long period of time.
Yeah, I think that's well said. In fact, I had on my notes here, and I was trying to determine whether I was going to tee it up this way or not, but I had on my notes, poorly structured whole life insurance. So that's the direction I was going. And I really think that this is something that's a critical message that we have to get out to people, because to your point, when it all gets lumped in together, it blurs all of the lines. And suddenly people are thinking that they're super confident in exactly how this is, especially people who've had bad experiences, right? So let's play this out. Let's say that I'm a physician who had a New York Life agent connect with me. They came to the hospital and did a lunch presentation, and I decided I'd sit down with them. And they said, hey, you're making a lot more money now. You've got to protect your family. Smart people use whole life insurance. It's, what's $3,000 a month as a premium, right? And so you're that physician and you're like, okay, well, I'm making a lot more money. I want to do the right thing, the responsible thing. And I've heard from some places that this can make sense. So you go ahead, you jump in, you buy your policy, you're paying $30,000 to $40,000 a year. And 3, 4, 5 years into it, you're looking at it and you're like, I've been paying 30, 40 grand and I've got like very little cash in this thing. And suddenly it's like, this sucks. I don't like it. I don't want to use this. Whole life is bad, right? Or life insurance doesn't make sense to build up cash. And what's really happening is they're just seeing, to your point, Blake, one very specific version of it. Now, I think it's kind of weird. Like, how many industries can insurance be designed, right? When you think about your auto insurance, we don't think about a design to it. It is what it is. If something happens, if I get in an accident, then my insurance is going to pay out. Like, if term insurance is the same way, if I die, I know exactly what's coming. Well, permanent life insurance is this entirely different monster, right? It's why we oftentimes refer to it as a wealth creation tool, because we can use it for a lot more than just a death benefit. And when that starts to happen, that's when we start to unlock it. But if I'm one of those people who landed in the, 2.5% return New York life policy that didn't break even till 15 years out, I have had a huge opportunity cost, right? That's money. That's things that I could have been doing with my money that would have been a lot more effective had I realized it. And so for that reason, it can just be a huge drag. And it's hard because I actually have a lot of empathy toward the community that's talking about this kind of situations that's happened to them. And yet simultaneously, we're like really trying to educate on this other side of it, that, by the way, we have an entire community of physicians and high income earners who love it. Like, it's just this really weird and interesting paradox. But anyway, I wanted to make sure that we touched on whole life insurance, because certainly it's one that's going to get lumped into those kind of safe investments that typically don't do much for us, right? But to your point, if we do it right, we do it properly, it changes it. Go ahead, Brennan.
I do think too, speaking to a lot of our clients that have had policies in the past, or that have had conversations with other agents or advisors about whole life insurance policies, I think the unfortunate thing is, and I don't want to, throw other advisors or agents under the bus, because I don't think, it's always malicious on their part. Sometimes I think they're just explaining the policy, but they're not really explaining it exactly how it should be. Because what a lot of people are sitting down and meeting with these, advisors, and they're hearing it's a permanent life insurance policy. You have access to your capital, your cash. It's going to earn 5 or 6%. The dividend is 5 or 6% on the cash value. And so all of that sounds really good. And it sounds really similar to the way that somebody like, me, or somebody like myself or Blake or Christian would talk about these life insurance policies. The difference is, because it isn't structured properly, when they put in 40 grand a year that first year and they only get $1,000 or nothing in cash value, the 5 to 6% dividend isn't doing anything for them. Yes, it's getting a 5 to 6% dividend on the cash value, but there's nothing to get a dividend on, right? And so I just think that advisors will give you all of the really good things about the life insurance policies, but sometimes they don't know how to structure them properly to get you high cash value right away, and then consistently getting that 5-6% internal rate of return on the policy.
Yep, I totally agree. That's a great point. Okay, we're going to shift away from this. I'm going to do just take a minute and talk about what we've seen from our successful, like, wealthy clients who do it right. So maybe what I'd like to just kind of get from both of you is some of some of what you've seen. What are they doing different? We've talked about these things that could be dangerous, that appear safe, but that can be dangerous. What are some of the things that you see these highly successful, wealth builders doing consistently that is different from what kind of the people who aren't as successful are doing?
The first thing that jumps out to me as I talk with people, the more successful they are, the more I realize they have more things going on in their financial world. So, they might be hardcore focused and spending their time building their business, but then in terms of what they're investing in, they have a bunch of different, assets and revenue streams that they've generated. So I think you can, with the way that the world works now, and you can invest in all these alternative assets without you being the guy who's, putting the deal together and, going to find the house and buying it and putting in tenants and things like that. With being able to invest in things passively, find good operators, I think that's one of the things that pops out to me is that, hey, I've already got a bunch of income streams. Yes, my business or what I do professionally is kind of where I spend my mental energy, but in terms of my wealth creation strategy, it's diversified.
Okay, that's a really good point. There's never been a time where it's been as easy to invest passively. I say passively in quotes because there's nothing that's passive, but it's about as passive as it gets, right? When you're talking about work, if your primary job is to do due diligence on the deal and the rest of it is just happens, that's pretty darn close to passive income. And to your point, that's a huge opportunity that we couldn't find 25 years ago, right? It wasn't like the whole syndication world even existed at that point in time. So if you wanted to invest in cash flowing real estate, you had to go out and buy the real estate, at least for the most part, right?
Yeah.
So if you were an institutional investor, like you could get in on that, but as individual investors, that was really hard. So yeah, I think that's a really good point. What comes to your mind, Brennan?
I think the majority of our clients have diversification in what they're investing in. They have ample liquidity so that they have opportunity to invest in anything that comes up at any moment. And then they have specific strategy. And specifically, when I say specific strategy, if they're doing anything that seems like it could be or is traditionally a dangerous investment, right? Something like what we've talked about, whole life insurance. They have a specific strategy of why they're using whole life insurance to go out and create an additional layer of profitability and their other alternative assets. If they're paying down their mortgage, right, can be dangerous. They have a specific strategy and purpose for why they're doing that to go out and catapult their wealth. So everything that they do is specifically designed to grow and catapult their wealth, right, into the next 6-figure, 7-figure, 8-figure that they're going for.
I love it. Intentionality. You're right. Like most of the moves that they're doing are intentional and with purpose. Okay. Couple of closing thoughts. Here's the things that we see our clients do, and this won't surprise anybody, but number one, prioritizing cash flow, not just growth, right? We've got to get away from that mentality of the accumulation model is the way to go. Luckily for us, like the people we talk to typically aren't, but if you're talking to friends who feel this way, like just they've got to get this message. It'll be one of the most powerful messages, especially from a financial standpoint, that they can ever get. So the second thing is they use high cash value life insurance to boost their investment returns. This won't surprise anybody. Obviously, this is a big part of what we do, but it's because it just makes sense, right? If you understand it, you look at the math, you look at the liquidity, you play it out big picture, having that asset is just a massive, massive benefit. And then to your point, Brennan, they stay liquid and ready for opportunities, right? If you're not liquid, you can't jump on the opportunity. I was really excited. I mentioned this to Rod in a previous pod, but I was really excited about a new investment deal I'm in on, which is buying up CPA firms. I think it's going to be like really powerful. And had I not been doing exactly what we're suggesting here, I may not have been in position to take advantage of it. It came up quickly. I was able to jump in on it, and I'm really excited about it. I'll keep y'all posted on how it actually does. Okay. I think that's everything I wanted to cover today. Thank you guys for filling in for my guy, Rod the Pod. You guys have been awesome. Thanks everybody for listening, and we'll see you next week.
Thank you for listening to the Money Insights Podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights Podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth-building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.